New properties have a massive advantage over old properties. I'm not necessarily 100% for new properties, but even if you buy, or consider if you buy a new property versus an old one, and I'm not going to do that comparison here, but I have done it before. A new property gives you a whole lot more money back in your pocket. I'm going to show you in this example, versus buying a second-hand property, which isn't going to give you as much back. Yeah, sure, it might have a little bit more capital growth, but the key is to buy as many properties as you can. And if that one second-hand property limits your ability to then buy another property, then you're actually better off buying two brand new properties using the depreciation. But I'm going to show you what this actually looks like. So this is a real example. I've picked this from a Brisbane suburb. It's actually a suburb I'm developing in at the moment. So this property, it looks like a run-of-the-mill house, but you can see that it's got two letterboxes. It's returning $6,500 cash in your pocket, or in this person's pocket, every year. And it was a $730,000 purchase. Now, these are not $730,000 anymore, but that's what it was. And it's growing at $70,000 per year. So this property is about a year old, and it's grown about that amount, about $70,000 per year growth. So not only do you get the cash flow, you get the growth as well. And a lot of this has got to do with the brand new property. So purchase $730,000, rent $820,000. So let's have a look at some of the costs. So you got mortgage, interest only. With investment properties, you put them on interest only. You don't pay off the principal. Yes, the rate is going to be higher, but there is a strategy behind this. You got rates and taxes, maintenance $600, insurance $1,800, management $3,300. Total cost is around $40,820 for this property. Then you got to have a look at the income. So this is the rental income. Remember, this has two mailboxes for those people that have just jumped in. Two mailboxes, dual income. So now your net cost, which is your income less your expenses. So this is about $2,000 a year. So it's basically neutral. Doesn't really put that much back in your pocket, but it's the depreciation advantages. So depreciation on this is about $16,000, which means you technically have $14,000 of write-offs. So that is paper write-offs, so paper losses. This is not real losses because you're actually positive by nearly $2,000 a year. So you got write-offs of $14,180. So this is going to vary depending on your situation and all that stuff, that little disclaimer down the bottom. So let's just take an income of $120,000 on this, just for argument's sake with the tax. Obviously, if your income is higher, this is going to be even better, but I'm just going to use a really conservative scenario. So your tax is normally $29,467. You got write-offs of $14,180. So now your new taxable income, and you can apply the same strategy to whatever your income is. And if you've got these write-offs, so now your new taxable income is $105,000. So now your new tax is only $24,859. So you actually get a refund of $4,609, which means that this property now gives you a cash flow of about $6,500 per year, or $536 per month. Now, one other thing that so many people don't know, I heard this a number of years ago, is actually from a seminar that I went to. You can actually get that refund. So if you're an employee, you can get that refund in your payslip. So instead of the employer holding the tax back, they actually give you that back every week if you get paid weekly or fortnightly or monthly. So there's a form you need to lodge to be able to do that. You need to talk to your accountant. If your accountant has never heard of this stuff, you need to sack them and get somebody that does. I have a fantastic accountant in Brisbane. It's taken me 6 accountants to find them. If you want their details, they are AH Jackson & Co. I recommend everyone to them. They are exceptional. I get no kickbacks for this, by the way. I just refer them because they will help look after you, and hopefully you can build a big property portfolio, and maybe you might even do one of the courses that I offer, or buy a property from us, or whatever. So this gives you $536 per week, per month in cash flow in this example. So obviously, if your income's higher, you're going to get a bigger refund on this, which means it puts more money in your back pocket. So the massive advantage with a new property is you're going to get a refund of $4,500. If this was a second-hand property, for example, and you bought it and it had a lot of land that it sat on, and you thought, oh, okay, the land's going to appreciate so much more than if I buy a new property. Yeah, that might be true to an extent, possibly, but your rental income is going to be less. Your write-offs, your depreciation is going to be less, which means you're going to get a lot less refund, if any at all. So in other words, this one, even though yeah, you might have to give up a little bit more capital growth. It means instead of buying one of these properties, you can now buy 2 and 3 and 4 and keep going, versus one secondhand property. Your serviceability is stuffed and then you're stuck with one. So just consider that if you're thinking, okay, I don't want to buy a new property, or I'm looking at these secondhand ones that are 20, 30 years old and I think they're really good value. That might be the case, but it's going to stuff up your serviceability moving forward, and it's going to limit you from borrowing and building a big property portfolio.